Welcome to JM Financial Mutual Fund's Equity Outlook. In this short video, we would take a look at how different economic and market factors behaved in the recent past, but also look at our view on the Indian equity markets, which may in turn impact the positioning of our schemes. The Nifty index was up 1.2% for the month ended April 2024. The Nifty Midcap 150 index and Nifty Smallcap 250 index outperformed the large cap indices in April 2024 and were up by 6.3% and 10.5% respectively. Global indices ended the month of April 2024 on a mixed note. Dow Jones and Nasdaq were down by -5.0% and -4.4% respectively, and Financial Times Stock Exchange 100 was up by 2.4%. The India VIX saw a marginal increase in April 2024. It was at 12.87 compared to 12.83 in April 2024, up by 0.3%. The Chicago Board Options Exchange VIX saw an increase in the month of April 2024 and was at 15.65 as against 13.01 on the previous month, up by 20.3%. Sector-wise, Nifty Metal plus 11.1%, Nifty PSE plus 9.6%, and Nifty PSU Bank plus 8.5% were the top-performing indices, whereas Nifty IT minus 4.9%, Nifty Pharma minus 0.1%, and Nifty FMCG plus 0.5% were the laggards. Foreign institutional investor were net seller for the month of April 2024. Net outflows foreign institutional investor were rupees 11,027 crores. Domestic institutional investor bought stocks worth rupees 44,186 crores, whereas MFs were net buyers worth rupees 29,613 crores. Nifty PE is now trading greater than one standard deviation above the mean PE. However, it is still 10.7% below its peak. Nifty Midcap 100 PE is trading greater than one standard deviation above the mean PE. However, it is still 5.6% below its peak. The economic model is changing, and Indian economy could be a beneficiary. Till COVID-19, the economic model was fairly predictable. All factories were located in China, and the US ran large trade deficits, and the world was awash with liquidity. This situation has changed swiftly as American politics has dictated an American Atmanirbhar. The US has introduced 3 significant acts which is expected to change the terms of trade significantly. The 3 acts are: 1. The US Bipartisan Infrastructure Law. This law is expected to provide up to $1.2 trillion to modernize US infrastructure from transmission, transportation, and internet infrastructure. About $550 billion will flow into state and local governments in the future. 2. The Inflation Reduction Act, IRA, aims at investing $500 billion in new spending and to boost clean energy and reduce healthcare costs, among other things. 3. The CHIPS and Science Act. This law aims to invest $280 billion to increase US semiconductor capacity and enhance research and development and create regional technology hubs. Together, the US will invest nearly $2 trillion over the next few years to create an unprecedented increase in jobs and improve their homegrown technology and maintain their edge in manufacturing and engineering. The country has realized that it will need to spend significant amounts to stay ahead in the game of technology and improve its infrastructure. This move by the US will begin to have profound impact on the way the global trade will shape up in coming years. Here we try to explore what can happen to Indian companies and the economy in general. The US trade balance is on a steady decline post-COVID from a peak to $102 billion to $69 billion. But what can be seen from the trade charts of US, China, and India is that trade deficits of US and trade surpluses of China have peaked and are not increasing anymore for the past few months. In fact, since 2022, trade across all regions has not grown and has plateaued. Is this a new normal? Capital expenditure in the US has been expanding at fairly robust pace, from an annualized $6 trillion to $8 trillion currently. This expansion is expected to gather pace as the US races to improve its power infrastructure and increase investments in manufacturing chips and build out large renewable energy farms and data centers. We expect this trend to continue. The Fed balance sheets has also been contracting at a steady pace as indicated by the Fed and is expected to normalize. Higher government borrowings to fund the fiscal deficit will also increase the tightness and demand for money. The main issues that will ripple through the global economy is limited trade flows and capital flows from the US. This could raise production costs and capital costs simultaneously, which can prove inflationary and create a self-reinforcing cycle which may be difficult to break. What does this mean for Indian companies? Indian industry has not been able to match Chinese industry's scale or efficiency of manufacturing, and this has led to lower investments and production in India. Indian companies therefore have to import from China to service the domestic market in a cost-effective manner. With US companies moving away from sourcing from China, China's advantages of scale diminish significantly. This could lead to an initial fight to the bottom syndrome of Chinese manufacturers, undercutting prices to retain volumes, and then eventually lead to some consolidation of capacities and pricing discipline, helping Indian companies. Further, Indian companies have been incentivized through several means such as production-linked incentive, PLI, and lower income tax to create capacities and integrate backwards. This trend could be a long-term one and boost investments. Exports may be challenging, with the US focusing on nearshoring and creating domestic capacities and limiting imports. Exports to the US may be more difficult than before. However, India may benefit if US companies chose to diversify away from China. China is currently undergoing a period of deflation, and we can expect some stability once that trend reverses. This trend was also witnessed during the ASEAN crisis. We expect consolidation of capacities to stabilize prices and improve corporate profitability. Services exports will continue to remain India's strength, though there are some growth headwinds in the IT sector due to automation and artificial intelligence. Indian manufacturing at an inflection point. We expect FDI to improve as European companies in particular set up manufacturing and sourcing hubs from India. India's demographics will continue to play an important role as the world's largest supplier of incremental labor. The US has more favorable demographics than Europe and Japan, and hence their compulsions are different. We see potential in light engineering, manufacturing, auto ancillary, and chemical sectors. So we remain sanguine about these sectors' potential. Also, favorable government policies like PLI for import substitution through the Atmanirbhar initiative will result in significant opportunities for domestic manufacturing. Capital costs unlikely to decline. As mentioned above, global capital flows will be limited as the US continues to invest and trade deficits remain under check. This will help companies with strong cash flows to invest. Potentially, spreads in corporate lending could also expand as demand for money increases. While the reference central bank rates may remain at current levels, it is reasonable to expect that capital costs could remain firm. We also expect that as capacities and trade restrictions play out, pricing will improve, causing some secondary inflationary pressure. The panic in March 2024 seems to have eased, with small caps and mid caps making a strong comeback. Elections are expected to be in favor of the incumbent with continuity in economic policies. Valuations remain above average levels and remain a challenge, but there are interesting opportunities arising due to the above reasons. We will continue to see India's manufacturing sector to benefit from the current global economic outlook, but the headwind could be cost and availability of capital. Investors will need to maintain a diversified portfolio with liquidity, as opportunities may arise due to market volatility.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.